Hey everybody, welcome to Strategy Now here at MarketStream.live. My name is Joseph Cusick with the Cusick Group, securities offered by MoneyBlock. This is where I bring a strategy, an approach that you can take to your portfolio. Now, I just want to do a little side note here. We're actually working on some really exciting new segments that are going to be coming up in the future. We're going to have some guests on, and we're vetting out what I think is going to be a super fun and really cool new segment that we're going to add to Strategy Now, and we're going to put a personality in here that potentially would be pretty fun, and I think that you guys will all enjoy it. And the whole point and purpose is to maybe bring it down a little a level, a couple notches, so that those of you that are new, that are growing, that are looking to understand your finances and the markets a little bit more, it'll give you those little stepping stones so that when you hear some of the vernacular that comes out of my mouth, in other words, those big market terms, you'll have some context. So I'm looking forward to that. We're going to be vetting that out, but I wanted to tell everyone about it. Jumping in, healthcare is on everybody's mind right now. Taking a look at the XLV, which is the ETF that tracks the healthcare stocks. Those are both drug stocks, hospital stocks, insurance companies, and so forth. You can see right now that it's up about 9 cents at 74.57. One of the things I thought I could do is show you a strategy approach that you can do with one of the biggest holdings in this ETF, UNH, United Healthcare, large insurance company with this healthcare reform bill going to be supposedly voted on today, this afternoon. It's going to happen after the close, and the market reaction could be fast and furious, but it's going to be in the after hours and only in the futures. Taking a look at this, you can clearly see that the sector in general, it's in a battle. Makes sense, right? We have a binary event like this healthcare reform, repeal and replace Obamacare. So it makes sense. It's above its 50-day moving average, which is coming in at 73.41. That's support, this red line. This green line right here is short-term resistance at 74.80. That's the 20-day moving average. I'm just giving some context of where we can think about ranges. Now, if you're bullish, this is an opportunity where you could put on a strategy like, let's say, buy the stock, right? Stock goes up, you make money. But let's say that because of the fact that there is this binary event, this big healthcare reform bill that is coming out, you're not quite ready to put that risk capital at play. How could you actually go in and put a bullish strategy on with limited risk? Now, of course, with limited risk, you're going to have a limited return. Well, one way you can do it in United Healthcare is you can go in and do what I call a calendar spread. Now, we've talked about this before in Strategy Now, but a calendar spread is where you're buying a longer term option. In this case, I'm going to be buying in May. And typically, I'm going to expand this a little bit. And here we go. All right, so I'm going to look. The stock's basically trading around 165. Let's see, it's trading at 166. As a matter of fact, I'll show you it on a chart so that you can, okay. Let me get UNH. So it's a $166 stock. If you bought 100 shares, you'd be putting up $1,660. In this case now, $16,597 for 100 shares. So you're saying to yourself, well, you know what, I'm not quite prepared to put up that kind of capital, especially with this healthcare reform bill. You can see that the stock has basically been performing much like its sector ETF. And so with UNH now in this bullish, bearish tug of war right here, but still above its 50-day moving average of 164, we're looking to see if it potentially could get back up into this 170 range. So with that being said, let's take a look at a strategy that takes advantage of the stock getting up into the 170 range. So we would look at the 170 calls. They're trading $3 bid at $310 offer. So you buy them at $310. Well, that's $310 per contract. It's giving you the right to buy the stock at 170. Your break even is if the stock goes to 173. Okay? You only have a 40% probability of those being in the money at expiration. Well, I don't like just buying options outright. They're decaying assets. There's a low probability that this thing is going to be in the money by May. So how do I improve my potential odds of success? Well, I go in and look to sell an option against it with a shorter time period, right? With a shorter time period of being right, that means that I have more of an opportunity to be right on the trade in general. What do I mean? I'm going to look at the same strike call in the April expiration cycle. So it's going to happen before, so it would decay faster and it'll expire before the May option. Now I could collect around $1.78 for that particular option. So basically what I'm doing here is saying I'm bullish on United Healthcare and I'm bullish to May. I'm short-term neutral to bearish. In other words, I don't think that it's going to go above 170 between now and April. And plus, with the new Affordable Care Act, whatever it's now called, on the docket as far as being potentially replacing Obamacare, the bottom line is that I can buy the Mays, collect in the Aprils. If the underlying stays below 170, I basically will make about $200 per spread contract. My risk is going to be the ask price for the spread, which right now is right around $1.32. So basically, you're looking at around risking 132 to make roughly around 200. Okay, I like the risk reward. The probability or the trend right now is that it's short-term bearish, but still mid-term bullish until it breaks that 164 level, right? 164.30. The bulls are still in control. So I like this strategy. So what I'm going to do is I'm going to actually put it in at a limit price of $1.32 or better, debit, so you know that's your maximum risk. I'm going to review this order. And basically what I'm saying is that I think that United Healthcare could get to 170 between now and April expiration. Don't think it's going to go much above it, but if it does, I'll still make some profit. I'll stop making profit if it gets well above like that 171, 172 level once it gets up there through April expiration. But right now, the stock has pulled off about $6 from its highs this year. So I placed the order, and basically what I'm doing here is that I'm just playing the upside. Now, let's say if we flip it. I actually got filled at $1.22. Let's say that I actually want to go in, and I am going to, instead of playing the bullish side, I can also play the bearish side. And what I would do is just do a put calendar spread in UNH. I can actually set this up by create my own. I'm going to do the similar expiration months. I'm going to buy May and sell June. So I'm going to go to the May monthly expiration. The stock, I'm going to buy the first strike out of the money puts, and then that's the 160s. And I'm going to go in and look at the May monthlies, or excuse me, the April monthlies, and I'm going to sell the 160 front month puts. And let's see, it's currently trading for, I could do this for a debit of $1.18. So I'm going to buy the 160 puts in May, sell the 160 puts in April. My contention or my belief is that I don't think that the stock is going to go much below 160, but I think it could gravitate towards that, especially with the Healthcare Act on the floor right now of the House. So I'm going to say that I'm willing to pay $1.18, which is my maximum risk, or $118 per spread strategy. My total profit potential is between now and April, if the stock gets down below or at 160, I should make about $200, not including expenses. That's the commissions. So if you look at this and you place the order, there you go. It's now working, and I got both these positions filled, and they will be in my positions profile. Now, another thing that you can also look at is how much is the marketplace pricing in for a potential move in UNH. You remember that little trick that I showed you about the straddle strangle market? If you go in here and you basically say, okay, what I want to do is find out how much the market, the options marketplace, is pricing in the stock could move. Well, with the stock trading at 166, the closest at the money, closest expiration cycle is the week 3 expiring on March 24th, which is end of this week. It is tomorrow. I'm going to look at the 165 calls, right? You just click once there. That's the straddle, the 165 calls and puts. The next strike out of the put is the 162.5. Next strike out of the money call is the 167.5. You add up all of these offers, so 148, 149, so that's basically, we'll just call it $2. Here's 250, basically $3.10. You divide that by 2. You're basically looking at about a $1.60 move being priced in between now and the close of business tomorrow for UNH. That means that the market is saying that the range is roughly about 1%, either up or down, and that's in front of this healthcare bill. So now I have two positions on that could make money whether I'm bullish or whether I'm bearish, and they're going to take advantage of a big move. Now the market's not pricing in the type of move where it's going to 160. It is potentially pricing in going to 170, but really we're going to watch this closely, and that's how you can play both, whether you're bullish or bearish. Limited risk. You're using calendar spreads, so your probability of success is a little less than or right around 50%, but you have limited risk to your position. All right, folks, that's it right now for Strategy Now. Join me for Tech Talk at 3:30 Eastern Time, and then at 4:30 Eastern Time, we will wrap up all of today's action. And Paul Ryan's going to be speaking at 3:30 Eastern Time. We will be online when he is doing that. That could be moving markets, so we're going to watch that very closely. See you then.